Let's get after it. So today we're going to talk about all things stablecoins, payments, cards, and rewards. My name's Gabby. I lead sales and BD at Mesh. Mesh really sits at the intersection between payments, wallets, and exchanges. We're the connectivity layer that powers a lot of the money movement globally for some of the largest enterprises. Today, I'm really excited to talk about this panel, meet with you guys. I think cards has been one of the biggest emerging use cases over the last couple of years when it comes to applying crypto payments to real world. So let's get after it. If you want to introduce yourselves.
Hi everyone, my name is Ray. I lead business development for MetaMask. So many of us know us as obviously the largest self-custodial wallet. Cards are a huge component of everything we want to do as a company. We think really having that last mile is an incredibly part of our business. Having that self-custodial nature combined with the ability to spend directly on card is a huge unlock for us. For many years, one of the biggest issues I think with self-custody was if you actually wanted to spend your money, you had to off-ramp, which while we have great partners on that side, obviously that was a huge unlock. Now what we think about is much more as programmable money. So if you have money as a true operating system, you can spend directly of the card just in time. Obviously we have great partners across here, whether it's MasterCard, issuing banks, we work very closely, but we really think that this is the year for payments. We think cards can be a huge unlock, but to do that safely, the self-custodial part is a very key part of it, so we're excited to keep growing that business.
Hi, my name is Christian. I'm leading crypto go-to-market for MasterCard.
Hi, I'm John. I work on strategic partnerships at Rain, stablecoin infrastructure provider with a large presence in the card issuing landscape, working with Visa and MasterCard to off-ramp stablecoins.
Hi everyone, my name is Mark Zalan. I'm the CEO of GoMining. We are a Bitcoin ecosystem and the top 10 miner in Bitcoin. And yesterday we introduced the instant Bitcoin payment protocol called GoBTC Pay that allows Bitcoin payments at the point of sale in a self-custodial fashion at zero cost to the user. So we're very excited about that. I hope to add that perspective to the panel discussion here today.
Awesome. Thanks, guys. Appreciate you being here.
Of course.
Let's kick it off with the first question. I'd like to go around with everyone and just talk through, we've been talking about crypto cards going mainstream. From your seat, what does that adoption really look like?
You want me to start?
Yeah, we'll start at the end. Back to you.
Can you repeat the question?
Yeah, what does adoption look like bringing crypto payments and crypto cards mainstream?
It's convenience and a very simple UI experience. Various providers are doing it now. Not to sort of harp back on our own story, but I think that's actually the problem that we're trying to solve. We've solved actually. That's been around for 18 years, is being able to buy a cup of coffee with Bitcoin instantly at the point of sale at zero cost. That is what GoBTC Pay is all about. We actually have a coffee shop out there in the entry hall that is able to take Bitcoin payment and able to confirm the transaction at the point of sale. So I encourage everyone to go out and take a look. We're actually providing $20 worth of Satoshis to experience the instant payment protocol using Bitcoin at layer 1 without any wrappers, without any custody compromises.
Yeah, I mean, we tackle this problem more from the issuer side, so where people already have their money and want to spend. The card networks over decades have rolled up hundreds of millions of merchants, so that progress is immense, and Rain explicitly did not want to reinvent the wheel. I think a lot of what people confuse in this landscape is there is such thing as a payment and there's such thing as a transaction. And in a transactional setting, there's an expectation of a return for a good or service. There's embedded risk. So, a user may not receive what they paid for and might file a chargeback. These are frameworks that have developed over decades and they're not going to change. But what has changed is there's been this new emergent form of money that people are engaging with very regularly and at a rapid growth rate. And that's digital asset-based savings and spending patterns. So Rain focused on effectively backwards compatibility of these new emergent types of value storage with legacy card networks that accounts for things like a life cycle of a transaction. When you go to a bar, you may leave a card. You don't exactly know what you're going to end up spending. I'm sure that was a pattern with a lot of us here in Miami this week. So there's so many patterns that are not accounted for in push payments. So Rain has taken a lot of inspiration from our partners to figure out how to accommodate those transactional settings to just make it work. And if you look at the data, retail spend of stables, the fastest growing category is cards. It was about 105, 106% year over year in the past year. And that's a very interesting, it's still a small part of the card business, but it's a very interesting emergent pattern. And we take, the effect of an exponential very seriously. So that's why we're, ensuring that we can work extremely closely with today's major card networks.
Real quick, I have a follow-up question. If you can share, what merchant categories are you seeing the most spend in, and or geographies?
Yeah.
If you can share any of that data, I think it'd be really interesting to talk through.
Yeah, the Latin American adoption story has been incredible to observe. You have markets in which stablecoin-based cards will soon account for double-digit percentages of all cards in the entire market. So that's, if you look at the growth rates happening in the next 36 months, it's amazing progress. And that's across a bunch of different card formats, whether it's custodial, non-custodial, cards sitting at a crypto exchange, cards that completely abstract the stablecoin experience from the user. And that's just kind of how consumers are accessing new ways to save and spend. In terms of merchants, it's not actually that exciting because it looks very, very normal to us. We see spend across typical MCCs, and our volumes now are large enough that they probably look very, very similar to the global averages. So the spend that we see is at the biggest merchants in the world in a pro rata ratio with that and buying a coffee. So there's nothing too remarkable about that, and I think that is what is remarkable.
Yeah, I agree. I think that's the story. Having been in the payments and crypto kind of convergence for the last few years, a lot of the narrative tends to be oh, okay, but this is only for a specific set of merchants, maybe high risk, et cetera. So the fact that you're seeing that data, I think, is really telling.
Yeah, and our merchants see fiat at the end of the day.
Yeah.
So, I think that is a little of a different paradigm than, direct push payments and stablecoins, which are starting to have new ways of managing risk, especially for some of these higher risk MCCs. We're observing, learning. There's a lot that remains to be built.
Nice. What about you, Christian?
From a MasterCard perspective, obviously our mission statement has been very consistent for the last 60 odd years. It's safe, simple, secure payments, wherever you are in the world. And obviously that never happens in a vacuum or in isolation. And as our world digitizes and as spending or as economic transactions change, payment changes, and the advent of digital assets, of course, unlocks new opportunities to use new technology, as long as it's compliant, safe to use, and so on and so forth. And we're very excited about that because we see that the world is changing, and if you don't take advantage of these technologies, then you run the risk of not being able to cater to the next generation of consumers that want to pay. And we saw that with fintech 15, 20 years back, where people thought, okay, yes, that for real, can I go into my brick and mortar bank if I need to? And fast forward to today, this is a very significant segment of the market, right? And there's still the very classical banks out there, and they will be there for sure. But I believe if we fast forward, again, today's consumers that just entered the workforce or just enter sort of the bankable age, they grow up with all of these things that we discussed today not being new, because they were there when they entered the bankable age. So they will expect that I can spend whatever sort of digital asset through the MasterCard network. And that's sort of our mission statement, combining what we call the power of the network, global interoperability, safety, security, compliance, with the choice of using whatever digital asset you want to see on that, want to be able to spend, and that's basically our approach.
Great.
So maybe to close that out and connect some of the dots, I would say for many years it was really a function for us on infrastructure and education. I think users had to get educated and the infrastructure wasn't there. I think we're very much past that point, thanks to partners like the ones that we have here. However, I still think the biggest issues right now, because crypto cards, I think while they've gone from novelty to more mainstream, you still need to keep in mind it's still less than 1% of global card spend. But the exponential, I think as we were talking about, I think is growing incredibly quickly. So that is what we're leaning into. But if I had to say sort of what's keeping it from mass adoption, how do you get the next 100 million users? Because today, I think at least what we see, it's primarily crypto native users, already have money on chain, and they want to make that spendable. That's great. But I think if you want to get the next 100 million, I think you really have to go to the last mile. And what does that mean? I think you need to have much easier on-ramping experience for users. That's where I think a lot of the partners can come in. You can make it easier for them to be able to on-ramp. I think if you can abstract this concept of networks, gas, fees, and then lastly, sort of leaning into what is uniquely possible with this infrastructure that wasn't possible in the past, right? I think if all we're doing is replicating the Apple Pay experience, I think it's going to be okay, but I don't think we're going to overtake. I think the way that you overtake is sort of some of the things that we're doing, right? Like just-in-time conversion of your crypto, any asset that you want to hold, how do you make it spendable sort of immediately? How do you make it so rather than giving your money to a custodian so they can earn money on that yield, how are you actually able to yield just into the time that you're spending? I think if we're able to get those three things right, I think we're going to be in a good step for those next 100 million.
Yeah, those are all great points. Is that what's on your product roadmap, or like what are you thinking about from a MetaMask perspective and how to like compete and continue to bring utility to your users with the card you launched?
Yeah, so I think if we're on the MetaMask side, obviously, we started on the self-custodial, we're always going to remain non-custodial. That for us is a huge unlock. But now we're starting to think about what are the unique things that actually sort of enables, right? So now we're working on expanding not just the networks that we cover, but really kind of making all that, I like the concept of the DeFi mullet, right? Where you can have
the
DeFi in the back.
Okay, the DeFi mullet, okay.
DeFi mullet.
Yeah,
which
like
is
the hairstyle.
more of like DeFi in the back, but to the regular user, it should feel like a normal, conventional sort of experience that they have. So what does that mean? Abstracting networks, abstracting gas, abstracting fees, potentially actually going down and actually working directly with the local partners to have those local rails. So when you're looking to on-ramp, for example, and I think a lot of people, for example, we talked about the LATAM, sort of rise of LATAM, but I think as I talk a lot about with my team, and they even mentioned to me, LATAM is not a monolith, right? The things that work in Brazil are very different than things that work in Argentina, very different than things that work in Mexico, the on-ramps. So now we're going much more local, because for a long time, the unique advantage of MetaMask was when we launch a product, it's global on day one. Now, if you're going to rebuild that on the payment side and to really have that card experience, you do really have to invest. So we're investing in geographies. We're going very deeply, country by country, not just through the branding and the go-to-market, but really thinking through how do you have that full stack of infrastructure partners that enable you to match that experience.
Yeah, that makes a lot of sense. I mean, I'd be curious to get John's take, just given your expertise in the area. Are you seeing like one of these players that are launching cards that you guys are powering doing it better than others, or what are some patterns that you're seeing that you think work?
Yeah,
and I'm going a bit off script here, so.
No, totally. I mean, I think in terms of what you said about what's the art of the possible on these rails, quite simply, Rain was the first business to ever settle a major card network on a weekend. On a bank holiday, on Christmas. And that, if you think of a global enabler or a player that can enable card programs at global scale, you have a lot of overlapping holidays. You might have 4 days off in a row across 2 banks, right? And from a working capital perspective, that's trapped capital, right? That's people who need to pre-fund the networks or borrow from the networks. And so effectively, it starts costing $1.50 to move a dollar. So just by unlocking daily settlement pathways to the networks using stablecoins that don't turn off, we can go to our partners and offer them a working capital framework that reduces trapped capital by over 40% in many cases. So that's all capital that can be reinvested in the business. It could be reinvested in rewards, something that we're talking about here. And so a lot of our emergent customers are growing a lot faster than FinTech 2.0 because they're accessing global rails and they can do things in a very cost-effective manner. And that's just on one side, across product types, debit, credit, et cetera. There's also novel on-chain mechanisms that we can embrace. Many of our customers enable their users to lock funds in DeFi vaults and earn yield. Many of our customers draw down on on-chain lending facilities to advance funds however they may need to. And smart contracts can be leveraged to optimize flows and optimize repayment. So there's a ton of innovation happening under the hood that's effectively allowing the next wave of fintechs to be a lot more operationally efficient, and maybe they will grow 5–10% faster than their predecessors and really win the markets full stop without the customer even having a complete view into how well they're running things under the hood. So there's tons of examples across our portfolio of clients that are truly, truly innovative.
Nice, that's great. Christian, question for you. I mean, you work at MasterCard. You've been at the intersection between crypto and then traditional finance. You've been working in the space for quite some time, but when you look at MasterCard, you guys have billions of cardholders. So how do you see the next wave of adoption come for the mainstream users that maybe don't own a stablecoins yet, don't have a crypto wallet yet, to start using stablecoins as a payment method?
I think we touched upon our two themes were already mentioned. One is user experience, and the other is, for me, pushing the technology in the background, right? Because what we see in payment, nobody wants to pay, right? And other than people in this room, nobody says, oh, I just did an on-chain payment. Like people, the normal benchmark these days is you have a card sitting on your iPhone or in Android, you tap it, the money's gone next day, or you see the transaction immediately. And I think this is working really, really well. And of course, there's parts of the global economy where you can't build up capital stock and all of these things, so that's a different question. But when it comes to the payment user experience, I think this is where the North Star is. But then being able to tell people, by the way, you have a tokenized money market fund that sits in your on whatever fintech platform, and just until the second you tap that card, this is generating yield for you, and then all of this is happening in the background. This is what excites people, and for me, it's almost like as we transition from internal combustion engine cars to electric cars, right? You don't win. The first generation of people say, yeah, I want to have an electric car for the sake of it. But if you want to grow from 3% to 30%, you need to speak to them in terms of problems, languages, and value adds that don't put the technology first, but put the user first. And again, if you say, okay, you have a card, you can spend whatever asset, it happens in real time, no additional cost, you have the MasterCard network, and you can on-ramp in 2 minutes. If you put it to people like this, and then in the small print says, by the way, this is powered by blockchain or stablecoins, I think that's where you really take that leap from an early adoption technology that speaks to people in this room, to people who don't really care about it. It's almost like the first generation of cards on an iPhone. People would say, oh, by the way, they create a little, like a digital alias of your card and they put it there, it's super smart. Yeah, that's great for 5%, but the next 90%, it just should work. And I think that's where we need to get in digital asset payments.
Yeah, I agree. When I think about distribution, like the word invisible almost comes to mind, where like when we're going to see stablecoins really go mainstream and be a mainstream use case for payments, it's going to be invisible, so the users aren't even going to know that stablecoins are part of that transaction, but it's going to be widely distributed.
But
great.
it's about the why of that, right? Which
Yeah.
is, to me, it's about programmable money. So if you think about, the way that we think about MetaMask is your money operating system that could sit, right? So in a world where you have programmable money that can move between flows, obviously I think the agentic sort of is the next sort of wave that we see coming there. And I think that ability to have programmable money that moves automatically, preset rules, that's what I think is the huge unlock on the stablecoins. That's the why.
Yeah, I agree. Great. All right, Mark, let's go to you, man. Let's talk about rewards, because rewards are a big part of payments. So when you think about rewards now, they're fairly static, right? Like you have an Amex, you spend it, you get rewards for it, they sit there in your account, and then you have some sort of benefits around it. Walk me through how with stablecoins, with crypto, we could rethink that, innovate that, and move users away from an Amex.
Let me maybe circle back a little bit to the previous question, because there's a lot of points made here that I want to maybe provide a little bit of a different take on. From our point of view, we're Bitcoin maxis. We think that Bitcoin is the one and only and the original sort of promise of electronic cash. We don't think that the world needs these thousands of stable coins, whatever, that come with concepts like DeFi mode and abstracting transaction fees and abstracting conversion fees, et cetera, et cetera. If you think about it from a user perspective, you want to have your coins in a non-custody way, and you want to be able to spend those coins in a very simple format, like a tap to pay or read a QR code. You don't want to be, it's not that you need somebody to abstract all of those conversion rails and 100 companies to make their 0.5% conversion fees because you're forced to on-ramp, off-ramp, convert, et cetera, and abstract and build modes around that captured spend. All of that is directly in the face of the original promise of the whole ethos and the whole approach of being able, having custody of your economic capital and being able to spend it in a way that's convenient to you. And we're just bringing all of these, Warren Buffett called it little helpers, that are sitting there in the value chain, in the economic value chain, looking to make their 0.1, 0.2% by taking one bit of economic value and from one place to another place. And it seems like all of this conversation is about that, whereas our view, and I realize it's probably a bit contrarian on this stage, but our view is you have the original crypto that is a huge store of value that is now $1.6 trillion asset class. If you're able to figure out a way to enable instant payment at the point of sale, which is what we are focused on and what we're enabling, then that removes all of this complexity about on-ramping, off-ramping, gatekeeping, conversion fees, and all of that non-economic value add rent payment that has been so prevalent in the finance industry. And I mean, I spent 15 years in consumer finance and in card systems and so on. So we all know that it's there, and we all know that that is a typical rent-seeking behavior. And we think that if you can take all of that away, flush all of that away, and get back to the original ethos of everybody's keeping their savings in Bitcoin. We know that that's true. They're converting to stablecoins just to spend it at the point of sale or whenever a big expense is coming up. But all of that is unnecessary.
I have a question for you. So, like, your thesis is that people want to spend their Bitcoin.
My thesis is people want an easy spend, and Bitcoin is what they're keeping their long-term savings in. So if you keep your savings in dollars and your spend is in dollars, you don't need to be converting to another currency, cryptocurrency. I mean, when I go to spend my dollars, I don't convert it to euros and then convert it to something else and then spend it in some sort of different way. So my point is that all of these conversion mechanics and all of this regulatory capture I don't think it has long-term legs behind it. Right now, it may be viable for a year or 2 years or 3 years while people are trying to fit 20, 30 different stable coins into the existing regulatory framework. But our view is that on a 5-10 year time frame, all of that is going to get flushed away because none of it adds actual economic value to the user, to the customer, to the economic value chain. It's just a bunch of little helpers taking their 0.1%.
I mean, but you know, and again, this perspective is completely ignorant to whatever is required to facilitate a true transaction. If you want to buy a house, you have a real estate agent. That real estate agent collects fees for providing a service.
And yesterday, people drove in buggies with horses, but the future is not that.
Yeah, but look, I mean, there's fundamental value in someone protecting you in a transactional setting.
But
if you move a
protecting
ship,
is another word for capture. Protecting is another word for rent seeking, for capture, for trying to skim that extra 1 or 2% off of your transaction by protecting us. You know, protection is a code word for rent seeking.
So yeah, and when there's credible frameworks on chain, it would be very difficult on the Bitcoin network in my estimation. But when there is credible ways to self-custody and protect yourself, then I do believe margins will be compressed. But there will always be a scenario in which a transaction has inherent risk, and risk is paid for. You know, when you ship a good from, you know, when you ship a commodity from one country to another, there is a bank involved that issues a letter of credit and is funding the asset sale.
Yes,
right?
that technology has been around for 400 years, and then the smart contract is now here to replace it. So we can keep on trying to hold on to the way that people did things since Venice 800 years ago, actually, or we can actually go with smart contracts, which is what tokenization is all about.
Well, the smart contract was the innovation of Ethereum. It wasn't the innovation of Bitcoin.
So I'm gonna cut you guys off because we're unfortunately almost at time.
Sorry about that.
The conversation was getting spicy. I definitely had some great perspective too. You have a unique perspective, Mark. We have 1 minute. Let's do a final quick fire. 2 years from now, we're back on this panel. We're talking about what crypto payments are and the innovation that's come. What does it look like? What does it look like in 2 years? Yeah, Christian, you can go.
Or maybe just referencing to Mario, and I don't even disagree, and I think choice and optionality, I think everybody that wants to do what you just spoke to, they should do it. But 90% of the population were socialized with deposit insurance, zero liability and chargeback, and I think payment is more than moving money from A to B. From a consumer perspective, the experience of payment is interoperability, safety, and security. And I think if we keep this sort of at the North Star, we will be at a point where it's relevant to a very large share of the population. That would be my
Every
statement.
movement has their maxis.
Yeah. And I think it's great, right? If you don't ask these fundamental questions, you will never sort of, you know, do significant change.
Awesome. Appreciate it, guys.
Thank you very much.
Thanks for your time.
Thank you.